Who is there? Hey, it's you. Well, come in, since you've arrived. I was told that you are interested in trading the financial markets? Then you have come to the right place. Sit comfortably in your chairs. Grab a pen and notepad or a coffee and donut. We begin. The basis in all markets is 1. Structure. 2. Liquidity. 3. Zones of imbalance. Since the market is built on human psychology, it is very manipulative and tests our strength. And therefore, it is extremely important for us to know the structure, or in other words, the direction of movement of the asset. I am sure that the question immediately arises in your mind. Well, how to do this? And you will be damn right. If everything were so easy and unambiguous, then everyone would be millionaires. Of course, there are some nuances here, and there are quite a few of them, but everything is in order. I'm sure you've already watched some of my videos in which I share my knowledge about simple but very profitable tools that can be used in Forex, stocks, or cryptocurrency. And also subscribe to my channel so as not to miss the release of new videos. What do we know about the structure? We know that many of the most outstanding minds in the financial sector have tried to unravel this mystery. Take Elliott, for example. His theory is simply excellent, but having studied it and applied it in practice, we are faced with the difficulty that there are no clear rules in determining waves. For example, if we take 10 traders who trade using wave analysis, then each of them will see the structure differently, which again leads us to a dead end. In addition, each wave of a higher time frame has its own substructure on a lower time frame, and that one has its structure, and so on. The result is a nesting doll in a nesting doll and no certainty, which leaves most traders even more confused. But the desire to trade takes over us, and we, in search of at least some certainty, turn to indicators. We download and install dozens of different indicators, looking for at least some clear picture. And this is the most critical mistake that could be made. After all we need to determine the structure and direction of movement is a set of certain rules that are formed in the market. Yes, we will not always be right. Yes, we will incur minimal losses, but we will be clearly confident in our actions, and the mathematical expectation will do its job. Have you heard of swing? Or, as they say on the internet now, the correct rollback. This is a formation that consists of 3 candles, or bars, whichever is more convenient for you. Since Japanese candlesticks are more often used than bars, I will explain to you using their example. So, the market is fractal, and if I show you a chart without a time frame designation, then with 100% probability, you will not be able to tell what time frame it is, and that's a fact. But it is also an indisputable fact that on lower time frames, there is much more noise and manipulation than on older ones. And that's why most novice traders lose their money in the market by trading 1-minute and 5-minute charts. You need to determine the structure on a higher time frame, but open trades on a lower time frame. And you will be happy. So, let's look at what proper kickbacks look like. As I already said, a correct rollback consists of 3 candles or more. To form a swing, we need candle 3 to break the high for a bullish pullback or the low for a bearish pullback. These are 2 candlestick patterns, but there are 2 more patterns, and this is the inside bar. The indoor bar is also divided into 2 types, and each type has its own logic for constructing the structure. I'm sure these thoughts are running through your head right now. Damn it! How can you see all this? All candles are alike. There is no need to be afraid of this. Everything is much easier than it seems. All you need is practice. A day or two and you will, without much effort, see all the correct pullbacks on the chart and perfectly understand the logic of price movement. But remember, practice, practice, and practice again. Let's take a closer look at the logic behind the formation of an inside bar. The first option, there is an impulse movement in the first candle, but in the second candle, the movement is slowing down. This is a candle of uncertainty. If we look at its formation on a lower time frame, we will see a sideways movement and an exit from it. If with the first option, everything is extremely simple, then the logic behind the formation of the second option is more cunning. The inside bar is an accumulation, but the mother candle is a movement that removes liquidity from both sides of the inside candle. This is a reversal formation. If you look at the lower time frame, you will see a break in the trend, or chosh. Look again at how the correct rollback is marked by wave movements. It is very important. This is the basis. A little practice on marking the correct answers, and finally, how to use them in trading. Everything is extremely simple when you have practice. Believe me, it's not difficult. In addition, note that there are clear rules, and this gives a huge advantage over other strategies in which one movement can be interpreted in different ways. Still, I think that this material is enough for one video. Otherwise, your head will burst like a soap bubble. I'll tell you how to use the right rollbacks to determine the structure in the next video. I will also show areas for decision-making and the market entry points themselves. Good luck to everyone, and see you in the next part, and in continuation of the video with the mark of rollbacks.